can't take a vacation soon. I really need one. All right. So what's going on? Obviously, the market's up because they're open, so they must be going up. Look at my silver. Ah, what a great day. Nice $8,000 profit on my silver trade, and I'm sticking with this guy. I think it's going to pop. When I get 16, I'll probably get half out. But I'm pretty happy about this right now. Dollar's going down, gasoline's down, oil's down there. Let's see what else is going on. What else do I have? I have natural gas. That's pretty sad. That's not doing very well. And I have coffee, also not doing well. So thank God for silver. I'd be in trouble. But silver's getting a nice pop. It was like 20 cents today. So it is amazing. Oh, and the indexes came down a bit too. That's nice. Don't know if there's any particular news on that, but we'll see. All right, things look like pretty much in order coming into the Fed, and then we'll see how drastically everything changes once she starts talking, or once they give their meeting news. Yeah, Vegas baby is right. I got to get out of this place. All right, yeah. If I start being late for things, you know there's problems. All right, let's see. All right, FTR goes ex-dividend, 60 cents dividend. Should I sell a call today to protect downside? Hey, look, if you intend to ride it out, it doesn't matter that much. But we were just talking about the possibilities. With FTR, first of all, if you sell a call that has less than a 60-cent dividend, you're probably going to get called away because it's worth it for the guy who has to call it away. It's at 10.15 now. It's had a nice run, fortunately. You can sell, like May, $10 calls, because we're at 10, for $1.25. And now, of course, obviously there'll be a dividend now. There'll be another dividend in a few months, like in April or in March. And that will, again, knock it down 60 cents again. So the question is, will the stock rise faster than the dividends knock it down? In other words, every time they have a dividend, it's cash out of the company. It's going to decrease the value of the company. So the closer you get to the dividend payment, they build up the cash, and then they, boom, spit it out. Now, at some point, they might lower the dividend. Then you've got a problem. And then it'll come down fast. So you could do that. Or if you're just basically in the stock for the dividend, you can lock down the dividend by selling like the $8 calls here for like, say, $2.70. So you get $10.70 now. So you're effectively selling your stock, not for $10.70, I'm sorry, yeah. If you sell these guys the $8 calls for $2.70, you're locking in $10.70, and your anticipation is that you're also going to get a dividend every quarter. Now, here's the thing. You're going to get called away at 8. You're going to collect $2.70 now. That's a year's worth of dividends right there. You expect, obviously, to not be called away this dividend. You're going to get your 60 cents. If it goes lower, you're protected all the way down to 8. If the stock goes higher, the worst case is that you're going to collect another dividend's worth of payment if they call you away. So in any given time after this time, it doesn't hurt you to be called away. The only thing that's going to hurt is the regret. If FTR goes to $15 or $16 or $20, you're going to say, oh, son of a bitch, I'm getting called away at 8. But by selling the the 2020 $8 call for $2.70, you're effectively right now selling it for $10.70. So even if you get called away, you don't care because you collected a big dividend. You collected a nice dividend on it. So you're going to get 52 cents even if they call you away in this first time, and you're ahead of the game. And then you just buy the stock back. Frankly, most dividend stocks, that is how I like to play it. I know people are behind on FTR. That's why, in fact, we recently doubled down so we could exactly do something like this when it did pop. So the point of when we doubled down was so that when it came up to 10, we could double down, bring our net down below 10, and we get called away and we don't care. Because by the time we get called away, we'll be even. We'll be better than even. We keep collecting the 60 cents. Which is, remember, all we ever wanted to be in the stock for in the first place was to get the 60-cent dividends every quarter. Now, we can't count on them continuing at this pace. This is an incredibly large dividend to be paying out. 24% they're paying out in dividends. If they cut this in half, it would still be a good dividend stock. But probably the price of the stock will drop if they cut their dividend in half, even though I think that would be a smart move because they pay down their debt a lot faster. So anyway, so if you're going to sell dividend, just the point is, if you're going to sell a call to cover a dividend-paying stock, make sure the premium you're selling is close to the dividend so that if you do get called away, at least you collected your premium. You know, that's the key to something like that. All right, so what else is going on in the world? What do I want to talk about? We got the Fed. Oh, let's take a look at the oil. We've been talking about green coin. Where are we today? There's a 337. We were talking about how like there's all these different exchanges with different prices, and that this Yobit exchange is very market. Here you go. See this Yobit, very unreliable pricing. Although they do have some transactions, you can't count on what the transactions are. Really, you got to go by what the pricing is on the coin exchange, which has a decent amount of volume and prices it out at the last price. Basically, that's the more reliable one. Apparently, this thing, Coin Market Cap, takes them both into account and somehow averages them. That's what Chris was explaining to us. So we'll see what happens. All right, so that's just because that screen is up. I wasn't really going to talk about that. Let's see. Petroleum status. Here's the 1 o'clock report. Let's see what the hell is going on here. Well, what is going on is oil, energy, hourly. Oil took a pretty good tumble. It was yesterday, 58.50. You can't blame the oil report, the inventory, because what happened is you had a huge, huge drop here. That mostly we were up because of that leaky pipeline in the North Sea, which is, you know, not really affecting us anyway in America. But that caused oil to pump up, and then it just came back down as soon as they said, oh, it's going to get fixed. You know, it's just silly stuff. It really meant nothing. Then yesterday, the API report at the end of the day showed a pretty good draw in oil, but the EIA report, it netted out to not much of a draw. In fact, here, where's our... show you what the API looks like. There. So we had, well, we won't look at it anyway. So it shows we have 5.7 million barrels of oil building. I'm sorry, gasoline. We have 5.1 million barrels of crude drawn down, 5.7 million barrels building gasoline, which is huge, and 1.4 million drawn distillate. So what you always do with these things is you add them up. All right, there's 6 and 1/2 dozen of another, but you say, look, this is these two are plus 6 minus 1.4, so the net draw is 800,000 barrels drawn down. You have to consider, though, that's 800,000 barrels drawn down with OPEC continuing their cutbacks. So basically, despite huge cutbacks from OPEC, in an entire week, we only used up 800,000 barrels of our reserve. That means it's going to take about 50 years for this thing to really have any effect on us. So it means basically the OPEC cuts are completely ineffective. Now, this one says ends December 8th, and distillate fuel decrease, average, blah, 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 imports average, commercial inventories decreased 5.1. Okay, so this is definitely the right report. And then what you want to do is look here. Let me make this bigger. You want to see if anything weird sticks out. You know, you always want to look them over and see if there's something odd happened. So no change week to week here, no change here, no change here, no change here. So in other words, why was this report different than the last report? Always look at all other oils because that's sometimes where they mess around, but not big deal. 2 million barrels of all other oil. Nothing here. Couple million barrel net move, no big deal. Exports. This is imports. Sorry, but imports. We imported, look what we imported. Last year, 7.2 million barrels a day was imported. This year, 6 million barrels. And that's down 200,000 a day. So we imported in 1 week about almost 1 million less barrels we imported over the course of a week. From last year, though, we imported 8.4 million less barrels per week than we were importing last year. And still, we're not drawing oil. That's the real story here. If you want to get a story out of oil, that's the story. Not only that, though, but we're exporting 800,000 more barrels than we exported last week in petroleum products. So we're exporting, what's 8 times 7 is 5-something million. So we're exporting 5 million barrels more, and we're importing 8 million barrels less. That's 13 million barrels net less consumption. Since we're not building, there's no build, right? There's no build, there's no drawing oil. We have basically 13 million barrels less consumption. That's an entire day less consumption per week in the United States than we had last year. That is a story. And that's a story about fuel efficiency. It's a story about electric vehicles. It's a story about solar replacing fuels and things like that. This is a big, big story that nobody is following up on. But it's the same thing I've been saying for years, is why oil isn't going anywhere, and this is why Aramco is in huge trouble, because you see these same numbers in Europe, and you're starting to see these kind of numbers in Asia. But in 1 year, we are using 13 million less barrels per day. I got to write this as an article tomorrow. That's an important point. Nobody's talking about this. It's just amazing to me. So look, we're supplying the same amount of product. It's another key thing. Last year, 19 million barrels. This year, 19. A bit more product, but we're only supplying the product so we can export it. It's all getting shipped out. We're not using it. We're exporting it. Now, price-wise, this is where it's completely bullshit. Price-wise, we're paying 15% more per barrel when we're using about 12, 14% less. That's really unfair. Gas, too. Gas is up 20 cents, also 15%. So we're paying 15% more for gas. We're paying 15% more for oil because we're using less, but because the sons of bitches in the freaking Congress changed the export laws, we are now shipping it out of the country so American citizens pay much more for gas, and we ship out the gas at profitable prices, and the energy companies make the money. Every single man, woman, and child in this country is paying 15% more money so Exxon can make a better profit. We used to have laws that didn't allow them to export this much gasoline. Now those laws are thrown out the window, and they're just exporting as much as they possibly can. And we're getting screwed for it, even though we're being good and we're consuming less. Even though we are doing our part and consuming less and lessening our dependence on foreign oil, these sons of bitches are taking the oil we have and shipping it out after they refine it. That's what's going on in this country. It's disgusting. How low will FDR go? Because I sold a $5 call on it. Like you said, I'm underwater now. The stock may be exercised. Well, you will be exercised. You sold a $5 call. You're going to get called away. So basically, you're just going to have to buy it again and sell some more calls. Or you can either buy it again and sell some more calls after you get your money and after it gets called away, because probably it's going to go lower after the dividend's paid out. Or if you want to capture the dividend, you can double down now. I wouldn't do that, though. See, I wouldn't double down now. It doesn't make any sense because you're paying top dollar before the dividend. You might not even get the dividend because you're too late now. I don't know the ex-dividend rules are, so I was just saying possibly it would be too late to capture the dividend yourself. And then the stock would drop because it paid the dividend to somebody. So, I mean, at this point, I would sit tight. When you sold the $5 call, it was an amount you thought you would get called away from. You were protecting yourself. The stock has gone much higher since then. But you still get the $5. You still get the $5 being called away. You get the $2 of whatever you sold the call for, and you won't get the dividend most likely. But then you just have to buy it and set it up for the next cycle. So you buy the stock for 10, you'll sell the $8 call, like we were just talking about, and then you'll be into net 6. See, so it's not hurting you, because if you buy the stock, well, got to be realistic. The stock is now 10. You can sell these $8 calls for $2.70, so that's net $5.30. So you're going to get called away for $5 less whatever you sold those calls for. I'm sorry, not less. Plus, so let's say you sold those calls for $1.50. So you're going to get called away for $6.50. But you can immediately, and you're not going to, you wait until this thing drops, but you can immediately right now turn around and sell this and buy and spend 10 minus 270, which is 730 or 740, whatever it works out to. So you can get back into 740. So you're not really losing anything. You're going to get back in at a low price, and hopefully this will come down to like 9 something. You'll still be able to sell these for maybe $2.50, and then you'll be netting in for $6.50. And there won't be any difference, and you just wait for the next dividend. And of course, if you have any short puts, those are going to be in good shape, so you don't have to worry about those either. So, it seems bad when you get called away and stuff like that, but it's not. It's fine. You just roll it into the next position, and there's no problem. And the point is, you played it safe, and you're getting your money. You're getting paid. Roy Moore waiting for God to intervene. Roy Moore. If God intervened, God should have intervened. Why won't I get the dividend? I'm sorry, you won't get, if you get called away before, there's weird rules about ex-dividend and the timing. Only your broker knows for sure. If you look at FTR, do I have a regular Yahoo screen? I guess I don't. Back. Oh, here you go. Back. FTR. So ex-dividend date is 12/14. Today is the 13th. Now, in theory, that means that if you are the holder of record on 12/14, now it's at the beginning of 12/14 and the close of 12/14, I don't know. It's very hard to say, and the broker might say no. But anyway, the bottom line is overnight tonight, you may get called away by the guy who you sold the $5 calls to. He becomes a holder of record. He's calling you away so he can steal the dividend. So he paid money. You charged him for this privilege. He paid money for the right to take your stock anytime he wants for $5. So he'll call it away, pay you $5. He'll immediately get a 60-cent dividend tomorrow. So he's calling you away for $4.40. You'd be silly for him not to do that. And the only difference is that it cancels his short call. So you would no longer owe him the short call, and you get to keep the cash you sold him that call for, and you're now no longer obligated to that guy. But you also no longer have the shares of FTR that you sold the calls against. So that's how it works. But it's no big deal, because whatever you sold it for, if you sold it for $1.50 and you get called away for $5, then you netted $6.50. That's how you got called away. Obviously, you're disappointed because FTR went up much, much higher than $6.50. But that happens sometimes. Next time, maybe it won't go up higher. You can't always be happy, but if you consistently sell your calls against a stock and you collect, even if you collect 50 cents every quarter selling the call, like what we just said, like, look, you buy the stock for 10, forget 13, 10. You buy the stock for 10, you sell the $8 calls for $2.70, right? So how much comes out of your pocket? $7.30. So if you get called away at 8, you're getting a 70-cent dividend. But you've only put in, so you put in $7.30. So every quarter, what's going to happen to you from now on is either you get called away at 8, in which case you got a 70-cent dividend, or you don't get called away and you collect your 60-cent dividend. So maybe some quarters you'll get called away, some quarters you'll collect your 60-cent dividend. But either way, you're getting the dividend, which was the whole point of the exercise. And especially when that dividend is 10% of the stock price every quarter. Let them call you away. That's a sure thing, because then you're in cash The stock drops after the dividend date. You buy it back, you sell more calls. It's a process. See, what we did last time, where is it? Yeah, I just pointed that out. Control F, FTR. We were just talking about this in the chat room. Here. So what we did last time, I don't know how well you can see this. Zoomy. Okay. So last time, our FTR position, this is back on, when was it? Our last review. I don't know, it was 9-something. It was sometime in September. No, it wasn't September. No, November. It was like November 19th maybe, or 9th, or something like that. Anyway, so at the time, FTR was at 692. Okay, so that's like about a little more than a month ago. So FTR was at 692. It's getting close to a double since then. And our $10 puts were 645. So what did we do? I said at the time, we can't not double down here. So we bought 6,000 more to bring it. We more than doubled down. We brought it up to 10,000 shares. So we bought 6,000 more at 695. And we sold. Now, let's make sure we understand what happened here. So by buying 6,000 more for 41,700, okay, plus how much did we originally spend? We spent originally 79,560 plus 79,560 is 121,260. All right, so we divide that by 10,000 shares now. Is 1212. So that became our new average, was 1212. We sold the $8 calls for $1.10, but only 50 of them, right? And sell 50 of the $8 calls for $1.10. So we divide that by 2, and we basically divide, so minus 0.55. So now we're in for 1157, basically. So our new average on FTR is 1157. But we're half covered. We're not all covered. So we're going to collect half the dividend. So even if we get called away on part of it, okay, we still have 5,000 shares, and we collect the 60-cent dividend, and we have no obligation left over here, and those go away. So then we're down to 5,000, and we can easily double down again. We can easily just go through the same process again. And like I said, here we did $6.95 minus $1.10 is $5.85. So we paid $5.85 net last time for these shares, and we sold the $8 calls. Oh, I'm sorry, but we're not going to get called away. We sold the $8 calls in 2020. I was smart. I believe that's different than maybe we did in the opportunity portfolio. But in the long-term portfolio, because we have a lot more money to play with and we have a lot more time, we sold the $8 calls. So even though they were only $110 at the time, now they're $270. They still have more premium than the price of the option, than the price of the dividend. So even if we get called away, we don't care. It's still a good deal for us. All right. So in other words, see what we did here. We sold for $6.95 minus $1.10 is $5.85, and if we get called away, we get called away at $8. So that's a $1.15 profit. So I don't care if we don't get the dividend. If you're going to give me $1.15 profit, that's more than the dividend was going to be. And then I have cash, and we can do whatever the hell we want again. It's just a process that you go through. But if every time you go through it, you make sure you make 50 cents, and you do that once a quarter, you're going to make $2 a year going through this process. You just have to make sure you do your math right, and you know how you get called away, and you have to basically robotically just rebuy and resell short calls to recover yourself. But also be realistic, because now we had a hell of a run. We came up from less than $7 to over $10. So that's like a 40% jump. So you have to be wary of like overpaying at certain points. But still, it's still a great stock. It's still on our list. We're still going to want to buy it, and I hope it does come down considerably because we're out of it now. We cash in everything. Yeah, if you sold the 2025s at 230. Okay, see, that's good though. You sold the 2025s at 230. That was 730, and at the time the stock was 6 something, right? So you got 730 when the stock was 6 something. Even if you get called away now, it's still $1.30 more than you had before. Okay, then next time you'll get the dividend. You'll go through this process again. But if every time you go through the process and it fails because you got $1.30, that's fine. Okay, it's not a terrible outcome. What be a new trade on WPM? I'm sorry, but I'm sorry. I cannot accept this grammar. It's unacceptable. I cannot answer that question. What be a new trade? We be making big new trade. If you want to start work WPM from scratch, and now's a good time, by the way, because silver got crushed. It's just coming back, of course. But let's see how I'm doing. How am I doing? Love it with my stuff. Look at that, 1591. Jeez, should I take some off the table? Am I being greedy? Look at that. Yeah. All right. Let's lighten up a little. 1, 2, 6. One more. 5. Okay. So now if it goes back here, I'm happy to add 5 more. All right, but I got a little off the table. I got a nice little profit, and I rest my laurels on that one for now. So where were we? What were we talking about? Something reminded me of something. Oh, Wheaton, right. So anyway, so silver took a huge dive, and Wheaton came down. Oh wait, I want to find the individual stocks. Yeah. Actually, it didn't even come down so much. It's actually fairly flat, considering how much silver came down. It's been holding up well, but it's a hell of a good stock, and they also, they trade a lot of stuff. We targeted, I think 22 was our target for these guys into next year. So if you want to start from scratch, I don't really see why they would break much higher than this. They're going to be, unless gold and silver really take off. But basically, this is a good price for them. Maybe 25 at the most, but I wouldn't bet on. At that point, I think they're overpriced. But a stock doesn't have to gain money to be a trade of the year. It only has to do what I think it's going to do, because we can leverage the bet. Oh shit! Look what happened to me as soon as I sold a few. Good thing I kept it. Wow! What, were they waiting for me to sell so they could rack it up? That's okay. Still making money. My humble 5 is still doing okay. I'm sure it's going to get rejected at 16. What if it doesn't? What if he just blasts high? It's like the Bitcoin thing, right? It's like, what if it goes to 1,000? You can't run your portfolio like that. Oh, shit. Just one thing to sell it. Come on, baby. All right. Discipline. Down to 4. Screw this. All right. 3. Nope. I'm going to take that one. Give it a second to see if it goes. Do not look gift horses in the mouth. In the time I was about to say it, I'm like, it's going to get rejected at 16. Of course it's going to get rejected at 16. So if I know it's going to get rejected at 16, why would I not take my money off the table? The 3's good. All right, let's leave 3. Now I'm half of where I was. I feel very responsible in what I just did. You see what happened? The dollar fell sharply. Oh, the Fed, right? Fed raises GDP forecast. What else happened? Shit. I was so behind on my time, so I'm not even paying attention. All right, so the Fed minutes came out. Hang on a second. Let's see what the next one is. Okay, they raised their GDP forecast for next year to 2.5%. Two Fed members dissented from the raising the rates of 0.25%. And they have 3 hikes in the forecast now for next year. So really not very exciting. I'm not sure what all the market movement's about. Really nothing happened. It's sort of zigzaggy. But anyway, so when you see a silly spike like that, you take advantage of it because it's almost certainly going to correct. You know, there was nothing happened in silver that was making it do that. It was a dollar falling, and the course was still up. And there's nothing the Fed said that was really out of line with what was expected. So hang on, where were Wheaton Precious? Anyway, all right. So Wheaton doesn't have to move. That was the point I was making. Let's get to that after we look at the Fed statement. That's kind of important. So done with these guys, right? FOMC meeting. It's a nice short statement we can read it for ourselves and tell us what it says. I'm going to wait for Yellen to say her, but Dow's up another 130 points today. Incredible. Okay, last statement of the year. Statement, material. Oh, I see. The materials are out too. Let's start with this. All right. Information received since the open market, since the last met in November, indicates the labor market has continued to strengthen, and the economic activity has been rising at a solid rate. The hurricane-related things. You know, they expected to rebound off the hurricane, and they got it. Job gain solid, unemployment rate declined, household spending has been expanding, growth in business investment has picked up. Good. Everything's good. On a 12-month basis, overall inflation items other than food has declined and are running below 2%. So market running great, inflation non-existent. That's basically what they're saying, which makes no sense, but we'll take it. Somebody tried to explain it yesterday. There's an article, I think, in the Wall Street Journal. And what they're saying is one major factor keeping consumer good prices down is everybody has a computer now that they walk around with in their hand and they don't get ripped off. It's like you check the price on anything you're buying. You know, people who care. You know, here's the thing. We're in, you know, most of you guys are in at least the top 10%, maybe the top 1%, right? So we're all in the upper class of America. So we're not inclined for these habits, but we're not the ones who are buying all the goods and services that inflation is measured in. Okay? In other words, I go out to Whole Foods. I don't sit there and look at the price of every item, and I just buy a bag of groceries, and I know a bag of groceries is going to cost me a couple of $100. I know a cart, you know, whatever. But a cart of groceries is going to be like $200. That's just the normal bill at Whole Foods. If it's $220 or $250 or $240 or $180, I don't care. It's just whatever it is, and frankly, if something's on sale, I'm not necessarily. If something's on sale and I like it, I might buy 2 of it, but I don't not buy something because it's not on sale. And most of you guys are the same. You're not running in there with coupons and so on and so forth. You know, I don't get really held up at Whole Foods with people handing in coupons. It's like, why would I be here if I'm going to clip coupons? So. You know, we're just buying our stuff and paying the prices, but we buy the same amount of groceries, more or less. I mean, somebody who earns half as much as me or a quarter as much as me in the middle class, they might buy they'll buy a cart of groceries too, but they'll only spend $120 on the same cart of groceries I spend $200 on because they're doing something different than me. Now, the point I'm making though is there's only one of me to every 10 of them. So it doesn't matter what I do; it matters what they do. They're keeping the money. They're keeping the cost of a cart down 9 times. For every 1 time I spend $200, 9 of them are spending $120. Their average matters a lot more than mine does. And those people are sitting there with a phone in their hands when they're buying groceries, and when they're buying oranges, they check the lowest prices on oranges in the neighborhood, and they check the lowest price on cereal, and they get things from different stores, and so on and so forth. This is the thing people do. And we do it. I mean, I do it for a computer or something like that. If I'm buying something expensive, I shop around. I mean, it gets silly at a certain point because I realize, like my daughter's laptop, I'm buying her a $400 laptop, and by the time I check 3 different sites, I'm like, what am I going to do? Save $20 more by checking more stuff? It's not, it's not worth the time. But that's because I'm capable of making $500 an hour, so it's a different thing. It depends how you value your time. But so saving money isn't my top priority in doing things. Saving time is a much bigger priority than even saving money. But average people now have the ability to save themselves a lot of money, a significant amount of money to them, by spending a little bit of their time. And there's the tipping point. But probably you can do, not to laugh at curve of work crap, but you can run like some economic curves, and you can probably show that people inherently they'll value their time in some way. So you'll see people who get paid. So the less you pay people, the more likely they're going to be to pay less money back to the employers for goods and services, because they've got to save their money. So in some ways, when you don't give when you don't raise wages, you're shooting yourself in the foot, because you're creating an underclass that can't afford your services. And by the way, that's one of the reasons I feel the world economy is basically going to plateau, because this is a global phenomenon. We're not paying the workers. We're not giving them significant raises. At the moment, the globalism, which is being shut down, but globalism has allowed us to sell to wider and broader markets overseas and stuff. So the companies in the U.S. sell half their goods and services overseas, especially S&P 500. So the American market is in decline as far as their spending power, but the companies have broadened their reach to overseas. But now the overseas companies are pushing back. The Chinese companies, the Japanese companies, the European companies, they're all pushing back, and everybody's now fighting over basically the same globalized consumer base, and that's why walls are coming up and trade barriers are coming in and tariffs and so on and so forth. So it's a different world we're heading into than the one we've been in, where things have been rising and rising and rising. Anyhow, so where were we? So but anyway, I'm sorry. So that was a theory as to why inflation is so low, even though everything is going well. People are just empowered to save money in so many different ways. Plus, you have Amazon doing the competition on that end. So, and what Amazon ends up doing is keeping everybody honest, right? Because anybody can check Amazon in 2 seconds and find out what something costs. And when you're in the grocery store, you simply don't buy something on Amazon. I talked to you guys a while ago. I have this automatic. Speaking of coupons, I would never. It's not like I'm an elitist, but I mean, I'm sorry, I have money. I'm not going to sit there and clip coupons. I never clip coupons. It's not a thing. When I was in college, I used to clip coupons, but they used to give you like triple coupons. That was the other thing. That seemed worth it. That seems silly not to do it, right? If they give you a triple coupon. But I don't clip coupons. But I have this app that whenever I buy something, it looks for a coupon, which is really cool. And so it tests. It goes over the web and it finds any online coupon, and before I get a chance to even click to buy something, it says, "Would you like me to try coupons?" And I say yes, and a little pop-up window, and it goes and tries coupons, and it saves me. Like yesterday, I was buying some cookies for Christmas, cookie dough, and it saved me 10%. Just like boom, I was just trying to buy the thing, and before I could complete my purchase, it said, "I think I found a coupon for 10% off. Would you like to apply it?" I'm like, sure. Why not? But then, no, go away. Start time today. No, go stop. Restart an hour. How about that? Yeah, okay. Anyway, what was I saying? So in other words, I saved 10% by accident doing something yesterday. And that's putting price pressure, of course, margin pressure on all sorts of things. All right, so consistent with their mandate, the committee seeks to foster maximum employment and price stability, hurricane disruptions, and building economics, blah, blah, blah. Committee expects that with gradual adjustments to monetary policy, economic activity will expand at a moderate pace. Labor conditions strong. Inflation is expected to remain somewhat below 2% in the near term and stabilize around 2% in the medium term. Near-term risks appear roughly balanced, but the committee is monitoring inflation development closely. In view of realized expected labor market conditions and inflation, the committee decided to raise the target range of the Fed funds rate to 1.25% to 1.5%. That means next year we're going to cross 2% finally. The stance of monetary policy remains accommodated, thereby supporting strong labor market and sustained return to 2%. In determining the time size of futures, Fed funds rate committee will blah blah blah. I mean, how many times can they say 2%, right? What they're telling you is that when they hit 2% inflation, they will tighten. So that's what we really got to watch is when this inflation kicks up. But today's CPI report, no sign of it. No sign at all that we're going to hit that. Session takes into a wide account of blah, blah, blah. Financial committee will monitor expected inflation. The committee expects economic conditions will evolve. The Fed funds rate is likely to remain for some time below levels. However, the actual path of the Fed funds rate says nothing about about winding down the QE. No, apparently, they're still doing what they said they would do. They had a very specific path of that, of lowering their QE by $10 billion a month every meeting, every month. I don't know. They're tapering it down to like no more QE by the end of next year or something like that. Now, 2 people voted against this, which is a lot actually. Usually one person checks at most. So 2 people think they're being premature. So that's interesting. Now, we'll back out. We'll look at the projections. Maybe I shouldn't have picked the PDF. Ew, that's ugly. All right, control. So, GDP next year, 2.5%. That's up from 2.1%. It's pretty significant up. Not much up in 2019. And notice how we're declining. So we're peaking now. This is it. So according to the Fed. Unemployment also, we're peaking at low unemployment now. Not going to change. PCE inflation, they think it's going to be magical and they can hold it 2.0 once they hit their target. Core PCE, same thing, 2.0. That's what they're looking for. And then these are just the ranges that they say. But the bottom line is GDP long term, this is nasty, 2% in 2020. I don't even know if they're taking into account the tax bill. You know, whether the tax bill is going to hurt, because it's going to hurt GDP in the long run. It's going to be a disaster. So we'll see what that leads to. All right. And so how's the market doing on this fabulous news? Nope, just drifting along. Silver broke over 16, son of a bitch. Oh well. Happy to make a little bit of money. Dollar's still down because they're being very gradual and slow, and the economy's not growing much. So there's not going to be a big demand for dollars with this kind of slow GDP projection. And so that's killing the dollar, and that's why silver's taking off, and gold is starting to take off also, so expect something nice out of gold. Wow, look at that. Boy, was I a little early on that one. We made another 10 cents. And I don't care, though. And we got natural gas. Here's my coffee. That's not really doing anything yet. YG, GX, GL, blah, 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 blah. How's my coffee doing? Trade. KC. ACHH. Hopefully coming off the floor. A little bit. Sitting down $10,000 on my coffee. I have 10 longs there. Silver now, 12. Look at that, $12,000. Who loves you, baby? Ugh. All right, I'm up $5,000. So I'm stopping. Take one more. Good day, $13,000, right? What do you think? Should we take it off here? Nope. Now we'll make it a stop though. So if it goes back below 1610, we should stop out. That's fine. Now I'm happy. That puts me in a good mood. And and see, that balances out. I got a 13. I mean, I profited here. I'm down on coffee, but it makes me. I'm happy to ride out my coffee and see. And this is the longer term coffee. And my natural gas. That's another one I'm down on, which is what NGV8. So natural gas is like October, and I'm down 4,000 on my natural gas. I'm waiting for that to pop. You know, this was down $10,000 at one point, so I'm very happy it turned around. You just got to wait. You know, you have to outweight the. Oh, look at that! Shit, while I'm talking about it, right? All right, so we're done with silver. That's plenty. Now watch it blast up. All right, back to WPM. We never got into what the actual trade was. We got distracted by the thing. So for Wheaton, with silver taking off like this, they're going to start pushing up too. Very simply, we're very happy to buy them for 20. So you can sell the $20 puts for $3. Okay, it says 329 was the last, but the spread here is about $3. So let's say you sell those for $3, and then you buy the 1750s for $6. I'm just rounding off, and you sell the 2250s, which is a $5 spread, for $3.70, let's say. So wait, what's this number here? 6 minus 370 is 230, right? No. Yes. 6 minus 370 is 230. Yes, it is. So it's 230 here. So you can buy 2 of the 1750, 2250 bull call spreads for 230, and you can offset that with the sale of the $20 puts at 3. So 230 and 230 is 460. Minus 3 is $1.60. So you're paying 80 cents per $5 spread. Your net price is 80 cents per $5 spread. All right, you're not going to get a discount. If you get a sign, though, because you paid 80 times 2, you're going to get a sign at 20.60, which is basically where silver Wheaton is now. So I'm sorry, not 20.60, 21.60. So you're paying in the worst case the current price, but what you have got is some huge leverage to the upside. So if it is at 22.50, you're going to get paid $10 for every short put you sell. So for each 160 you put up on the short, for each 160 you put up, you're going to get back $10. So you're going to make 840, which is whatever 6 times back on your money. So that's nice. So that's the way I would play it. I would sell 1 times the $20 puts for about $3, and I would buy the 1750, 2250 spreads for 230, 2 times that amount, and that would give you a very nice little position with a good return. And of course, you're already basically 100% in the money. So all it has to do is not go down, and you're going to do very, very well. So I like trades that pay you 500% if something just simply doesn't go down. And that's what I meant. We don't need something to go. You know, I'm looking for a good trade. I don't care if it's going to go up. Our goal is 2250. That's like a blip from here. So our goal in 2 years is to be at 2250. All I care about is that the value of the company is such that I don't mind having to own them for $20. As long as I'm comfortable with my floor, the ceiling will take care of itself. And I'm picking a very conservative spread there. You can be more aggressive, but I don't see Wheaton Precious as a big, I don't see it flying up to 30 or something like that. So I'm not playing it that way. I'm just playing it to say, this is a good floor I feel pretty comfortable investing in. That's what I like about it, is the safety I feel investing in. Same thing with like something like Disney. Disney's another good example. You know, I mean, a lot of stocks on our buy list are like this, but you know, Disney. There's no situation I can imagine in which I don't want to buy Disney for $95. Okay, it's absolutely worth $95. I don't like the, you know, they're buying this box thing, and who knows what's going to happen there. But it's a pretty volatile stock. So if I go to Disney and I start my trade off by the thing that I care about the most is what do I want to own Disney for? And so I go to 2020, and I feel I'm certainly willing to own them for $95, and I see that I can get like $8 for selling the 95 puts. That puts me into Disney for $87. So do I want to own Disney for $87? Of course I do. And so since I don't mind owning Disney for $87 or $95 for that matter, this is effectively free money. And I can then take that free money and construct a spread that'll pay me. So my net cash outlay is basically zero. And my worst case scenario is owning Disney, which I like the stock anyway. Now the only trick is, of course, there is a margin requirement, but it's not really severe, especially on a blue chip. If I sell, let's say $8. So if I sell 10 of these guys for $8, the margin requirement is $7,000. So that's it. Now, obviously, though, you can't have a portfolio that's filled with these things. Like if you have a $70,000 portfolio and you have 10 of these, 10 trades like this, you can't do that because if I am assigned, it's $95,000 worth of Disney by itself. So if you're assigned all 10 of the things you sold puts on, you'd be looking at like $1 million in your $70,000 portfolio. You get $1 million worth of assignments. That's not what you use these for. You have to do it in a proportion to what you can actually afford. So for the most part, if you only have a $100,000 portfolio, you shouldn't even be messing around with a $100 stock. But conceptually, let's say, ignoring the fact that it's easier not to even play a stock that's expensive, if you sell one, let's say you have a $100,000 portfolio and you don't mind owning 10. Let's say worst case you own $20,000 worth of Disney in your $100,000 portfolio. So you sell two of these puts for $1,600. Okay, and then you take your $1,600, and now you're obligated to buy 200 shares at $95. That's $19,000. But you collected $1,600 for your troubles. You take that money and you say, okay, well, I think Disney should be about $110, $120. So you say, okay, I can sell these guys for $14, and I have how much in my pocket? I have 8 in my pocket. So now I look down to say, 20. So 14 plus 8 is 22. So I get down to here, the 9250s, let's say, and I can buy the 9250 calls for 2350, and I can sell the 110s for 14, and 2350 minus that is what, like 950. So 950 minus 8 is going to be $1.50. So I'm paying net $1.50. So now I'm not doing 2 times, I'm doing 1 time. So I would take 2 of these and sell them, and I would buy 2 of these spreads, the 9250 110 spread, and sell that. And that's going to pay me, it's going to cost me $1,500 out of pocket to do the trade. No, it's going to cost me $3,000. Sorry. No, I'm sorry. It's going to cost me $150. It's going to cost me $300 total out of pocket for 2 contracts to do it, and the trade pays $2,500 back. So, now $2,500, not that exciting, or it doesn't seem exciting when you have a $100,000 portfolio, but you can do 10 of those spreads. If you have $200,000 in buying power, you can have everything to be assigned to you, you'd be able to afford it. You can get 10 of those spreads, and if they pay off, they're going to pay off $25,000 on a $100,000 portfolio. So you're making 25% just for doing spreads like that. But like I said, I wouldn't do it with Disney because it's too high of a stock. You do it with smaller stocks like Wheaton, where you get more bang for your buck. Or you look for things that pay more bang for your buck than that. But that's how you set up these spreads, and they add up over time. And then what you do, it's not, look, we're starting the portfolios from scratch, so you're going to see in January how we build these things from scratch. It is not sexy the first year. When we're building these portfolios, it's slow and steady, and the returns are not what you've been getting used to because we were able to get more aggressive as our portfolios build over time. We start getting more aggressive. But when we start conservatively because when you start, you don't want to lose money. That's all I care about is not losing money. And as we make money, then we can get a little more risky with the bets, but not when we start out. That's not the way we do it. What makes XPXL drop a lot when it's an ultra, it's a more than multiple ETF? I just joined, missed out most 217 plays your article. We didn't miss anything because we cashed out our portfolio, so you'll be able to go from scratch on January 2nd with everybody. Your article on the trade of the year and bonus idea are the trades in 2018 OOP. They will be, but they're not yet. Nothing. We have cash. We are cashed. There is nothing. There are no positions. There is no nothing. Okay, all these portfolios have been cashed in. James says, get Phil a coffee. Why? Am I too slow for you guys? Should I talk faster? Initial bump getting sold. It could get ugly. I don't think. I think it's just, I mean, what did they expect to happen? I think it's pretty much in line. Yes, it's coming back. It's pretty much in line with expectations. There's nothing special going on here. And I'm thrilled because things should normalize. And normalize means my coffee's going to start going up. I already got my silver money, and my natural gas should start heading back up too. Hopefully get a nice draw on natural gas this weekend. RB long for the weekend. Oh, that's always a good trade. Now that I'm out of silver, I can do that. Let me see. RB. Oh yeah, wow. Yeah, but you know what? There's a big build in gasoline, so I'm not too thrilled about this trade right now. I think I'd rather see it settle out because that build in gasoline was a nasty number. That just shows a tremendous lack of demand, and they're in big trouble. These guys are not prepared for that steep of a drop off in demand. And by the way, in Tesla with the trucks, if it's not bullshit, and other companies have electric trucks too, but if the trucks aren't bullshit, they are going to rapidly roll over their fleets. And especially when you can get into electric driverless trucks. They won't be able to fire those truck drivers fast enough and have these fleets of electric trucks, just drone trucks, just driving up and down the highways forever. 24 hours a day, 7 days a week, no breaks, no time off. You know, this is a dream for these trucking companies. By the way, though, we haven't looked at that, but that's one of the things I'm going to want to look at investing next year that we haven't invested in before is some of these trucking companies, because it's a massive game changer. Because, you know, the way it works now is the driver buys the truck, and he's essentially a contractor for the trucking company. But the trucking companies are paying more than half their money to the drivers, just like Uber, same thing. They pay so much money to the drivers, they only get a little tiny share of all the money that's being made. If they can get rid of the driver and have their own driverless trucks doing the work for them, they're going to make a fortune and double, triple their profits. So of course they're going to do that. Why would they not do that? Because they can easily get financing and easily get and run the revenues and get their money back. So now, of course, then the other thing is rates will come down. Then people start competing over prices, and rates will come down, and it won't be as great as they think it's going to be. But it will be better than it is now for them. Not so much for millions of truck drivers who are going to get laid off. I never heard you say that a $100,000 account should not be in $100 stocks. Can you explain? From an assignment perspective and an option perspective. In other words, if you sell one contract of $100 stock, you're obligated, one put of $100 stock, you're obligated to buy 100 units of $100 stock for $10,000. So now you've basically used up 10% of your portfolio of cash to sell one contract. So how often is that really going to be worth it and give you enough bang for the buck to make it worthwhile? Whereas, so Disney, we just did the example where you sell two contracts. You know, again, if you have a $100,000 portfolio, $200,000 in buying power, if you sell two contracts, you can get assigned $19,000 worth of Disney stock, versus if all goes well on the trade, you're going to make $2,500 in 2 years. So this trade's making you about 12% back on your not on your cash. On your cash, it's making a fortune, but on your portfolio balance, it's making you roughly 12.5% a year. So it's nice, but it's not thrilling. So you have to look at other things you could be doing with your money, like Chicago Bridge and Iron. Chicago Bridge and Iron is an $18 stock. Therefore, you can sell 10 of these, and you would have to buy $18,000 worth of it. So here, now let's say we're willing to, well, and again, here, look at the difference in premiums. Here I could sell 10 of the 1250 puts, so I'm only obligated to buy $12,500 worth of the stock at $310. So I'm going to collect $3,100, and I can then apply that to, let's say, the 15, which, oh wow, these spreads are disgusting. 820, that seems like a realistic price. All right, so let's go with the 12. These for 820, and how much should we sell those guys for? For $3? So you're getting 820 there, and wow, these spreads are horrible. Let's say the 2250s. Now, realistically, if these are 350 and these are 550, these are going to be 450. So 820 minus 450 is it's less than $4. It's like 370. All right. So 370 minus 310 is 60 cents, and we're talking about the 1250, 2250 spread. So you're getting $10 spread. So your payback, you're laying out $600 cash, and here your payback is $10,000. Is that right? 10 times 1,000. Yes, 10,000. So here your payback is $10,000 if it goes well. So that's 10% of your portfolio on one. That's 10% of your entire portfolio on one trade. That's the way you allocate a block of money, right? You're allocating a $10,000 block of your portfolio to make $10,000 in 2 years. So now that's going to make 50% a year if that goes well. So you want to have a mix of super safe things like Disney, where it's like it's a blue chip and you're not worried about it in a crash and whatever, and then you have to have a couple of trades like Chicago Bridge and Iron where it's probably going to work out, and you want to make a trade like that. So you want to look for mixes of trades, but preferably, stay away from the ones that are not going to pay you a good return. And then another good one would be like Ford, let's say, because Ford's another one. It's a blue chip and it's cheap. So, and it pays a dividend. So Ford at $12.75, I think they pay like a 5% dividend, so it's almost worth owning the stock. In fact, yeah. See, now Ford, here's what you do with another. In the education section or the portfolio section, one of the sections in PSW, we have a thing called Smart Portfolio. There's 3 articles on Smart Portfolio Management, and I'm going to rewrite them shortly to get ready for our new portfolios. But since the biggest concept here is allocation blocks, is that you want to set up, if you have a $100,000 portfolio, you should have $200,000 in buying power. And I know like interactive brokers will give you $500,000 in buying power. You should never use that. That's crazy. You can kill yourself with that kind of margin. But $200,000 is perfectly reasonable because you're taking a reasonable risk. So your reasonable risk in this case is owning Ford. So your allocation blocks are then you divide your portfolio by 10. Your buying power of your portfolio by 10, and those are your allocation blocks. So you have $20,000 allocation blocks for Ford. So you're willing easily to buy 1,000 shares of Ford for $12,000 because you could double down and still be within your $20,000 range if it goes lower. But you buy 1,000 shares of Ford for $12,700 and whatever dollars. You sell the $10 calls for $295. So let's say 3. So now you're into $970. Your net in Ford is $970, and you also sell like the $10 puts for 80 cents. So now your net is $9.79, but so let's say your net is $9 on Ford, and you're getting called away at $1, but you're getting the dividend, which is Ford. And you're getting the dividend, which is 60 cents. So for every net 9 you put in, you're getting 60 cents in dividends. So you're getting 15% a year in dividends, and a bonus 10% when you get called away at $10. So Ford could drop 20% from where it is now, and you still get everything you expected to get out of this trade. So that's another. It's a good blue chip way to put some money aside. Now, when you get better at running your portfolio, what you realize is when you do a stock like Ford, if it goes up to like $15 or if it goes to 14, whatever, as long as it keeps going up marginally and seems safe, eventually you say, okay, you know what? I only used it in your margin on a trade like that. Maybe you'll use like $3,000 of margin for that trade. It's going to make the same 1,000 plus 6 is 612, 22. It's going to make the same $2,200 regardless of what you do with it, because you got your 1,000 shares. But it's using only a little bit of margin in your portfolio. So you're going to get back on 3,000 in margin. You're going to get back $2,200. You get back like 60-something, 70% on margin. But when you first start out with a trade, you assume the worst and you hold $10,000 aside in your allocation block. But as it matures and gets more in the money, you basically, at some point in your mind, you can release the allocation block and go and buy something else. That's the trick that we do, and I'll be pointing out more to explain in the portfolio as we go forward. But there's a certain point in time where you stop worrying about a trade, and especially also we developed hedges, and your hedges then cover your contingencies. But there's a point in time where you look at that allocation block and say, well, I'm not worried about Ford. It's like, what's my, so you look at your trade and say, my out on Ford is $10 and Ford's at 14. So why would I worry about this trade? Why would I be concerned about the margin or anything on that trade? So that then releases your entire $20,000 allocation block to go do something else with. So it's all a matter of controlling that. Now, again, part of that release, though, is that you should at that point have hedges in case of a real big problem. So even though you release the allocation block, you still have something covering your Ford. But that's what we do. We look for trades like that, and then as they develop and as they go in the money, you then can make another trade and another trade. So it's not like you're tying up your money for 2 years and you have to wait. It's that after 3 months or 6 months, you can release a couple, and then you can add a couple more trades. And even though you only had a $100,000 portfolio, you can end up working maybe 30 different trades over the course of 2 years. 30 blocks of at least $10,000. So that's $300,000 worth of blocks, and you get a 20% return on that. You can pick up 60% on that, which is now 60, and it's 60% of 60%. It's not 60%. Sorry. If you have $300,000 blocks that you make 20% on, that's $60,000, and it's still the same $100,000 you started with. So you're going to make 60% on your $100,000. Say you're letting the money work for you and grow and as soon as it grows and has some returns, you put it right back to work. Get it back out on the street. Be a good pimp with your money. You got to smack it around and get it out there. don't let it sit just after it makes you a little bit of money. Don't let it sit around. Get it right back out there. Otherwise, it develops bad habits. See, I know all about this. I watch these. What's that show on TV on HBO? I don't know. They got some show about hookers. Learning about the pimp life. So let's see. RB account. I understand SPXL is an ultra. I do not understand it moving in the opposite direction of the market. Well, what does SPXL say? I mean, it tells what they do. SPXL. It's a 3 times bullish ETF. Well, it should move. So I'm not sure what the question is. I mean, if the market goes up 1%, it should go up 3%. The investment seeks a daily investment, 300% of the performance of the S&P. So it's an ultra bullish, this one. It shouldn't go opposite. That would be wrong. But in any given 5-minute or 10-minute or short-term period, it could do anything because it might not move in the same time. It might take time to react. It's not like it's directly connected. In other words, the S&P goes up, and these guys then buy more futures. You see, they can tell you what it's made up of. It's made up of iShares ETF, and it has the E-mini futures, and that's how they balance it out. So they have to react and buy these futures as the market goes up, and there could be a significant lag between what you're seeing from moment to moment. I wouldn't track them and expect some direct correlation. These physically have to be moved around all the time. But in general, I mean, look, if this is up 4.4%, then the S&P should be up 1.2%, which I don't think it is. What is the S&P up? Actually, it's up 0.2%. So it's ridiculous it's up 4.4%. I can't even understand why it would do that. So that seems really excessive. But what are you going to do? I mean, It does what it does. I don't. I never. Well, we play them sometimes, but I don't play a lot of them. Some of them are really weird the way they act. So allocations. Very welcome. Yeah, that's a very, very important concept. And I understand a lot of people don't get that, and that's why I wanted to. There is no way with a $2 million portfolio that grew out of a $500,000 portfolio that we could explain, block. It's such an abstract thing to explain blocks. But when I start with zero and we've got 100,000 cash, I'm going to have a much easier time explaining these concepts over the course of next year. So that's kind of another reason I want to get back to zero. Any trades on Clips? See, Clips is another nice, cheap one that you can add to a portfolio because it's not the worst thing in the world if you end up owning it. I mean, obviously, if it goes bankrupt, it is, but, ELF. So, yeah, they're sort of drifting along at $6. And they have really good option prices because people are worried they're going to go bankrupt. You can sell, and I would go 7, but you can sell the $7 puts for $2.10. That nets you in for $4.90. So you can just do that. And you say, okay, well, if it's $4.90, see, think about it, because if you do that, if it's $4.90, you'll buy it. And you own it for $4.90, which is significantly lower than it is now, like 20-something% lower than it is now. If it goes higher on $4.90, on the $4.90 that your worst case scenario is, you're going to make $2.10. That's like 50% for doing nothing. Now, if I sell it, so this is the kind of thing we do in the long-term portfolio all the time. Because if I sell it for 181, no, did I say 210? Screw that. And by the way, it's another thing. You guys do this all the time. If you don't get your price, don't sell it. The spread is 180-230. The last sale is 218. So why would I sell it for 181? That would be insane. So if I'm going to sell it, I'm going to tell them I freaking want 210. I'm not being unreasonable. Somebody just got, now it says 230. Isn't that funny? It just said 181 and now it says 230. Wait a minute. Oh, because I'm buying it. Oh, I see. Look, if I'm buying it, if I sell it, 181. Isn't that amazing? You don't have to listen to them. You tell her whatever the hell you want, and you say limit order. And now let's say we wanted to do 20. So I'm going to buy 2,000, and my net was these are the $7 puts for 210. So my net is low 5. So my worst case is I end up owning $10,000 worth of them, 2,000 shares for $10,000. I'm going to collect $4,200. My margin is $1,300. So basically, I'm going to put an allocation block aside. I'm going to collect how much? 40. I'm going to collect $4,200 against my $10,000 allocation block. Not even my full $20,000 allocation block. Against the $10,000 allocation block, I'm going to collect $4,200 now. And again, it goes back to that concept. I'm only using how much margin? I'm only using $1,300 in actual margin. So if it drifts along at $6, $5, $7, that, I'm still going to consider my allocation block at risk, right? But if it goes up to $10 or $9, even though the puts will still be outstanding, I'm no longer going to consider that allocation block tied up. And I can then take all the cash, except for whatever margin there is, and apply that to a new trade. So again, you send it back out on the street. It comes back to you a little bit of money. You smack it around. You send it back out on the street. Say, go get some more money. Say, what do you think I am? So get out there, work. That's what you got to do with money. You got to have a firm hand. I'm telling you, I'm inspired by these pimping movies. That's my new thing. I'm going to be options is pimping. I'll write a book or whatever you call it. Maybe I should watch more of those shows. What is it called? I forgot. I don't know. Some HBO show anyway. It's all about like porn and prostitution in the 70s. I'm just fascinated by the pimps and the dynamic there. It's like really interesting stuff. Any suggestion? Okay, so there's Cliff. Is any of this trade explanation going to be available for the OOP traders other than the weekly conference? I'll try. I don't. It's not the same service. It's the low price service that we have over at Seeking Alpha. But I try to put in when I'm writing up a thing. I try to say why we're doing it. So, to a lot of extent, whatever explanation I remember to put in is going to get in there. But the difference is I don't really have the same. You don't get the chat room over at Seeking Alpha that you get over at Phil Stockwell where we talk back and forth about this stuff. But you will get you'll be able to come to something like this and ask for clarification. Great insight on allocation might be something obvious, but if my portfolio is 300 cash, do I simply multiply the OOP trade by 3 times? Yes and no. Maybe you want to be a little more diversified and look at some other trades. But yeah, generally, yeah, that's the idea. That's why you pick a nice even side like $100,000. Because, the Dukes, thank you, Pat. That's the show. So to me, I'm just so fascinated by the whole dynamics that goes on with these pimps and how they get these women, and the women will do this and that for them, but they're businessmen. They're like really are. They're a lot of these guys are really sharp. Right? They know how to make money. That's what they know how to control people. They know how to make money. So obviously, if you have $100,000, if you're following a $100,000 portfolio and you want to follow it exactly, then you would go up 3 times. I would go up 2 times and see how it goes first. I wouldn't go completely crazy. You'll see you're kind of in the in-between place because there's a different sort of strategy we do with a $500,000 to $1 million portfolio than we do with a $100,000 portfolio. With a $300,000 portfolio, you have $600,000 of buying power, and you're able to go into more of our long-term portfolio strategy, which, look, frankly, to some extent it's luck, but it's also the market conditions. Like the options opportunity portfolio doubled. It made 100% the first year, and not 100% more, but then they made another 100% the next year. So no, we started with $100,000. We're over $300,000 at the end in 2 years. The thing is, though, that strategy was pretty aggressive, and also it was pretty aggressive, and it was a great market to be aggressive in. So I don't know that that's always going to work. Whereas my favorite strategies are the butterfly portfolio, which we have at Phil Stockworld, or the long-term, short-term portfolios. And what that is the short-term portfolio protects the long-term portfolio. The long-term portfolio was $500,000, and the short-term portfolio was $100,000. And in your case, you just cut that in half to the $600,000 total. And the short-term portfolio's main job is to protect the long-term portfolio. So generally, that's where all the shorts go. And in the long-term portfolio, it's all long positions, but also hedged. And that strategy is my favorite strategy because it works it gives you much more flexibility in any kind of market. Whereas in a choppy or down market, it's going to be hard to do better than it would be tough to pull 20% out of the options opportunity portfolio in a down or choppy market. So, we would have to probably switch up the strategies to do better than that. The options opportunity portfolio, when I started, was called the 5% portfolio. And frankly, Seeking Alpha, I don't know why. They said people were confused and we called it the 5% portfolio. I guess because people thought we were only trying to make 5% for the year. But the point was to make 5% a month. That was what I mean by saying it was an aggressive portfolio. But it was based on a strategy that was great for the kind of market we were in 2 years ago. Now, we're still in that market, but I've lost faith. 2 years ago, I was sure the market would keep going for at least a year, and we could easily expect to make 5% a month. Now, I'm a lot more cautious than I was as far as that goes. I'd be very surprised if we have another couple of years like we had the first 2 years running it. But if we do, we do, and then it'll work. But what I'm saying is that strategy is going to change very quickly to be a lot more cautious if the market goes down. Whereas, so with the options opportunity portfolio, if the market goes down, we have to turn much, much more cautious, and we'll be very, be looking to squeak out gains when we can. Whereas the long-term portfolio doesn't give a crap about the market conditions. In fact, sometimes the short-term portfolio does so well that it makes more money than than the long-term portfolio makes in the down market. That's not something we do in the options opportunity portfolio because we can't keep betting against ourselves. It's too dangerous. Whereas in the short-term portfolio, the whole point is to bet against yourself in the long-term portfolio. And in fact, our short-term portfolio, how do we leave it off? What is it? We're 350 in the options opportunity portfolio. Well, I don't know. I'm sorry, we're up 350. Huh. All right, whatever. So it's doing well. In the short-term portfolio, we're up about 300% in the short-term portfolio. In the long-term portfolio, we're also up 300%. So it's catching up because the market's so incredibly crazy. Look at that, 1,855. This is up $60,000 since we did our last review, which was when? Wait, 1.52. So we were at 1.52, and now we're at, where'd it go? No, that can't be right. What? Something's wrong. This is November. Let me do a small so I can navigate to it. Okay, this was November. 22nd. So this is not very long ago. The long-term portfolio was at 1.7. So it's just under 1.7. And now, wow, are you freaking kidding me? 185. It's up $150,000 since what day did we say that was? The 22nd or something like that? Since the 22nd. Well, not really the 22nd because it depends on what day we did the review. This is just the what do you call it? The 17th. Okay. So in other words, we did it on the 17th. This review is just putting together all the mini reviews we did in PSW chat. So on 11/17, we were at 1.7. It's now up $150,000 in basically less than a month. That's sick. That's what this market's doing. We shut it down last week, but that's beside the point. And of course, and that's why we shut it down, though, because it's ridiculous. You can't make that kind of money. It's unholy. So, you see why? Because here's where we were. We were down here, and that's what? That's 580, and now we're at 680, so up 100 points. So yeah, the whole S&P went up 5%, and the long-term portfolio went up 10%. Isn't that crazy? So like I said, I love that strategy in a bullish market. It makes a sick amount of money. But the short-term portfolio has been keeping up because surprisingly, even though it's a super bullish market, when we have a downturn, the short-term portfolio makes a freaking fortune. It's always ready to make money in a downturn. And the interesting thing about the way this market goes is when we have these downturns, like here, short-term portfolio, let's say here it made $50,000, but then we thought it was a bottom, so we cash it out. Then we go back up here. Then we start doing our hedges again. Then it makes another $50,000, and we cash it out. That's how the short-term portfolio makes its money. So we have these hedges. It crashes. If we think it's a bottom, though, we start taking the money off the table, and if it comes back up, which it has every time recovered, we never need to add any more hedges. If it kept going down, we would take the cash and add more hedges on the way down and make another $50,000 and another $50,000. So as it keeps going, boom, 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 we would make 50 and 50 and 50 and 50 on the way down to cover the losses in the long-term portfolio. But the way the market's been, we keep making like 50,000 cash it, 50,000 cash it, and then we get our money back. So there are cases in which we make more money on the short side than the long side, especially in a down market. The short-term portfolio can actually make so much money it dwarfs the long-term portfolio, even though the long-term portfolio starts off with 5 times more money. So, either way, though, the bottom line is, though, that we've done this for 10 years now. Either way, it works in almost any market condition running that kind of strategy. And the other one that works in any market condition is the butterfly portfolio, which also makes, considering how conservative it is, it makes an incredible amount of money. And an up and up market is not actually good for the butterfly portfolio because all these ones are self-hedging. But nonetheless, it's keeping up with the other portfolios. And basically, this is what they're all making about 40% a year compounded. That's pretty much we aim to make 20 to 40% a year, and look, the goal is not to lose money. That's what we care about most. But if you get a compound, I did this last week, but I'll keep doing it until you guys get the message. Because too many people try to make too much money, and they blow their account. And all you have to do is learn how to be patient. Because if you have $100,000, okay? And by the way, you should always put more money in. I'll show you why in a second. But if you have $100,000 and you're retiring in 15 years, that's not long, but whatever. All right? If you can make 20% a year consistently for 15 years, you will have $1.5 million. In other words, you'll make, on the average, every year another $100,000. It won't start out that way. At the end of the first year, you're going to have $120,000. And you're going to say, this isn't working. I only have $120,000. That's how compounding your money works. It doesn't seem very exciting when you start. See this? Not exciting, not exciting, not exciting. But it gets exciting over time. Now, here's what I want to hammer home also. Very, very big deal. So let's say, realistically, you're 40 years old. You got 20 years left till you retire. 25 years till you retire. 40 years old, you got 25 years till you retire. You've saved up $100,000. All right? And by the way, I'll show you another thing in a minute. So you save up $100,000. If you are making $100,000 a year, first of all, calculate. You're going to have 10 million at 20% a year. If you can consistently make 20%, not 40%, 20% consistently. That means not losing money. You'll have $10 million freaking dollars in 25 years. So this is why, that's why I tell people all the time, don't tell me you don't know how to, don't tell me you're not going to be able to retire rich. You can retire rich if you have discipline. And if you stop screwing around and invest sensibly for the rest of your life, instead of this crap where you chase this and chase that and whatever, just consistently make money. But here's the thing. Shame on you if you don't take $10,000 a year, 1/10 of your salary, and add it to your pot. Because if you do that, it goes from 9.5 to 15.2. Another reason also, by the way, if you add dividend-paying stocks, that also helps improve your numbers tremendously. But I want you to understand that. If you have $100,000 now at the age of 40, and you make sure, come hell or high water, every year you add $10,000 to your account, and your account makes 20% a year, you will have $15 million in 25 years. And by the way, basically, this does adjust with inflation because when you invest in stocks, the stocks will inflate with everything else, and the returns will go higher as inflation goes higher. And the dividends will inflate, and everything will inflate. So the stock market is a great place to fight inflation and keep your money going, right? Because if the price of IBM. IBM used to be $10, now it's $200. A lot of part of it's the growth in the earnings, part of it's just inflation. But that is earnings, because if they inflate, they sell their stuff for more money, they collect more money, they have more earnings, the stock price goes higher. It moves with inflation. So you don't have to worry about falling behind the curve on inflation when you do these things. Oh, Yellen's talking. It's certainly not helping the 10-year. Dow's still way up there. Anyway, so you understand this? Watch. Here's what happens if you save 10% of your money every year. Here's what happens if you don't save 10% of your money every year. You cost yourself $5-6 million. You cost yourself 50% of your retirement money because you didn't save 10% of your cash. You know what a difference that makes, lifestyle-wise and everything else? And I'm not talking about superstars here. I'm talking about you and your wife or your family. You earn $100,000 a year. You take $10,000 of it and say, absolutely, we're saving this money. Now, so here's a couple other things I really want to point out. Very important stuff. Okay. You have $100,000 in your investment account, and you're going to buy a new car. And you can buy a car that costs $50,000, or you can buy a car that costs $35,000. You buy the car that has $35,000, and you take the $15,000 and you put it into your account, and you work it over the same amount of time. You go from 9.5 to 10.9. So that's $1.4 million. Just because you didn't buy an expensive car. And believe me, and obviously the same goes for a house, because if you spend $85,000 less on the house and $15,000 less on the car, then you'll have $200,000, and you'll have close to $20 million when you retire. I mean, I really encourage you to play with a compound rate calculator a lot and get used to using it when you think about making life decisions and you want to say, should I save money? Should I spend money? Should I do this trip? Should I do this and that? It is crazy how people don't realize how much money they throw out the window when they don't do sensible things. And sensible things, by the way, includes investing sensibly. So what we're trying to teach people is how to make 20% per year consistently without losing money. That is my mission in life, is to try to get as many people as possible to understand how to do this. Because there's no reason anybody can't do that, even if you only have 15 years. $3 million. If you have $200,000 now, in 15 years, $3 million. Now, if you have $3 million and you're making 20% a year, that's $60,000 a year that you have to live on. But the key is in here, and this is again what people don't understand, is because if I'm currently, let's say currently, I make $60,000 a year and I have $200,000 saved up and I put it into this market account. Okay. Now it goes back to the same thing. If instead of having an expensive house, an expensive car, and this and that, I just put $10,000 more away every year. If I scrimp and save and get $10,000 more, or get another job, whatever it takes, because look at the difference, especially in the shorter term. Go from $3 million to $4 million, another $1 million by saving $10,000 a year for 15 years, by saving $150,000. Wait, I said 180. By saving $180,000, I will have $1 million more in 15 years. And this is a really crimped, short term. Having only 15 years to save your money is not long. But still, even if I'm making $60,000 a year, if I cut my lifestyle back now, I'll get myself up to $4 million. I'll have $80,000 a year. I'll have more money then when I retire than I'm making now, if I'm making $60,000 a year. But to do it, I've got to live like I have $50,000 a year, and I've got to put the rest of that money away. But, part of the reason people don't save is, first of all, it's not fun. But the other reason people don't save is because they don't believe in the numbers. And that's what you've got to use these things for. You've got to believe these numbers. You've got to see them in action. You've got to understand them. And that's why we ran our portfolios for 4 years. I wanted to show people what happens as it compounds, because what we kept doing is before this, we always would shut our portfolios down when they doubled. Our goal was like to double our portfolio. So they double, take a year, 2 years to double a portfolio, we'd shut it down. I wasn't getting this message home. I really hope I am getting this message home now. We can consistently, every single year, make this kind of money, and you will make a fortune if you stick with the program. But you've got to stop fooling around. You've got to stop going for it with these things that are speculative, because you can't afford the losses. You will not consistently make 20% a year if you lose 10% on this and that on a gamble. And that's why I let this whole Bitcoin thing basically pass me by. I don't care. I know I'm going to have money when I retire. I know I'm going to make my goals, because I'm like the tortoise and the hare. It's like I'm the tortoise. I'm making my 20% every single year. Some years a little better, some years a little worse, but basically at least 20% a year. And that's going to make me everything I could possibly need and everything my family needs by the time I retire. And that's what you've got to do. And nothing else matters. I don't need to get super rich. I don't need to be a billionaire. I need to be comfortable. I need to make sure my family is safe. I need to make sure my children and my grandchildren are able to go to college and have houses and so on and so forth. And if I can accomplish all that, that's about as much as anybody can expect to be, to deal with and take care of family. But you're going to get there by doing it conservatively, not by taking a lot of chances. All right, 3 o'clock. Can I wrap this up shortly? So the LTV might not be. No. We are going to have an LTV. We're going to have a short-term portfolio, a long-term portfolio. We're going to have a butterfly portfolio, which is my favorite portfolio. If you want to consistently make your 20%, that is mindless. It is the best, easiest way to do it in any market conditions. And we're going to have the options opportunity portfolio, which will be, well, it depends on the market conditions, but generally it'll be a more aggressive one. My SPXL confusion turns and coming and glitching how Ameritrade displays the gains on the, it's not meant to be watched short term. The idea is that you make an investment against or with the S&P, the projections for the S&P, right? My projection for the S&P in 2018, I think if we don't collapse in the first quarter, that probably 10 to 20% higher from here. And if we do collapse, then 10% higher. Either way, I think we're still going to end up higher. I just think that there's going to be a correction first. But more like 10 to 20% if we don't have a pullback. I think there'll be a sort of plateauing next year. But if we do have a pullback in the first quarter, then I think we'll probably top out about 10% higher than we are now. Which is still, pretty heavy. It's like 3,000? Is that where we are now? I don't even know what these numbers are. We're at 26, so basically close to 3,000. Crazy. Look, see, glad I got out now. Look, no, I'm not actually. I could have gone that. Oh well. All right. Hey, no bonus questions. Anything to do with SVU? We have a 13.20 spread, and SVU is now above 20. No, you're going to make your money. So wham. We cashed out, so I don't really have a lot to say about it. It's a great stock. It was a fantastic deal, and it's ahead of itself. So, we went to cash. We're going to look for things that are cheap instead of things that, the things that did well, did well. There's nothing wrong with SVU. I'm very confident it's going to pay in full. So if you don't have anything better to do with your money than wait to get your cash, then just wait. But we cashed everything out just to keep it simple. Is there any truth on IMF issuing SDRs in early 2018 bypass the dollar as a reserve, and that is the question. That's the reserve in cryptocurrencies. I don't think so. That'd be kind of crazy. It's a good rumor, though. I mean, look, the people who have Bitcoin, and look, I'm going to say it's a scam. It's not a scam, or it may not be an intentional scam, but it's effectively a scam. Just like people who were in the Madoff fund, who made, look, Bernie Madoff was a crook, right? He ran a crooked fund. He had crooked returns. He faked everything. It was a lot of bullshit, right? But it made real money for real people. There are people who were with him for 20 years, making 20% a year pretty much, okay? He did what I want to do, except he did it fakely. He would give people, which is, and again, 20% is a fantastic consistent return. And Bernie Madoff gave people 20% consistent returns. The way he did it, though, was by taking in money for new people and paying the old people, and he never actually traded anything. He just kept getting more and more bigger and bigger amounts of money in for the next year to pay the other people 20%. And then he would pay the new people 20%, and then he would get more money in. And he ran that scam for like 20 years. And there are people, the people who invested with him early got 20 times 20 back. They got 400% of their money back. But the problem is, unfortunately, because it was a scam, they all got sued. Now, Bitcoin could be the same kind of scam. That they can run it up and up and up, but it's based on nothing, and it's all going to fall apart at some point, and everybody's going to get nothing. But that doesn't mean real people won't make a lot of money. If you get in early enough on these kind of scams, then you make money, and if you get out. But if you don't get out, then you just basically you have fun watching a number go up and down in your portfolio. And now, that being said, so there are bad actors. Either way, whether it's a scam or not a scam, there are bad actors in Bitcoin. There are people who have a ton of Bitcoins who are going to promote it and spread rumors and have articles written that say all the stuff you're saying because they'll do anything to drive up prices. And since people don't know the difference and don't understand why that would be ridiculous for the IMF to revolt against the dollar, considering the IMF is based in Washington, D.C. and is run by America, it's not likely that would be their goal. I'm not the IMF. I'm thinking of the World Bank. Sorry, so the IMF. But the IMF is European. But they're not going to war with America over currencies. And we could easily, America tomorrow could put out their own cryptocurrency. Anybody can put out a cryptocurrency. That's the problem. Do you know how many people send me business plans that say we're going to put out a cryptocurrency and that's our business plan? It's horrifying. And there's no regulation. It's all going to end in tears. It's my grandmother's favorite expression. It'll all end in tears. And this will. So you're getting nervous about the crazy stuff. I'm nervous about the crazy stuff too, but it's up there. It really is. And again, blockchain to bypass banks. Why do you want to bypass a bank? What does the bank do to you? I know it's great to villainize banks, but what do the banks do to you? They get money from a bunch of people. They're safe places to put your money. I make money, I put my money in the bank. The bank pays me, well, in the old days, the bank pays me interest on my money that I leave in the bank. The bank will lend me money. The bank will track my credit. The bank will verify to other people that I actually have money when I need access to it. It's a seamless process. They've invested hundreds of billions of dollars in systems that allow me to take a little piece of plastic and go anywhere in the world, show this piece of plastic, and I walk into a hotel, I go to a show, I can go to a restaurant anywhere I want, I can buy something at the beach, I can get an ice cream cone on a street corner, I can use this piece of plastic anywhere on the planet Earth, and it doesn't matter where I am or what I'm doing or what the local currency is, I can just buy something and do it. I never have to worry about my money. I don't worry about what it's doing. I don't have to look at the value from day to day. That's a fantastic service. So what is blockchain going to do better for me? It's going to be, at its best, all it can do is be another credit card. What's the goal? So my employer pays me in Bitcoins, and then I use Bitcoins, and I keep them myself instead of giving it to a bank. Am I going to pay myself interest? No, I'm not. So right away, I'm losing out. Okay? Am I establishing credit by keeping a bunch of Bitcoins in my wallet? No, I'm not. So again, I'm losing out. So where's my advantage? Unless the bank is stealing your money, why do I care if the bank holds my money? You want an arbiter of money. You want somebody who makes a decision. You want somebody who protects your money when people try to steal it. Not blockchain where people can lose millions of dollars and anonymous programmers go, hey, sorry, I guess that chain collapsed. What can you do? You should have backed it up. Could you imagine if a bank said that to you? Hey, your money's gone. Should have backed it up. Tesla, yes, I'm very excited to short Tesla again. And they run on the banks. Yeah, all money is based on trust. So when did this happen to you? The economy, the world economy collapsed in 2008, and the banking system prevailed. It was an amazing thing. I thought it was going to collapse. I think we were right on the verge of a collapse, but we didn't. That was unbelievable that we didn't collapse in 2008 because it was a disaster. But it didn't. But people have not been able to get their Bitcoins back. People have lost. They say 4 million Bitcoins out of 21 million. So that's 20% of all the Bitcoins issued have been completely lost. So would that be bad if that happened to dollars? That would be pretty bad, right? That would be pretty catastrophic. So anyway, I know that blockchain people love to spread these fairy tales, and apparently you're reading all the literature that they want you to read to get you involved in the blockchain. But the reality of the situation is money is a really, really good system that's been worked out over hundreds of years and stood up to many, many tests and is doing very well for us. And why we would replace it with Bitcoin, no one has really been able to explain it. Why is it better? Who is it better for? Why is it a better system? We have a system that works perfectly well. Everyone agrees on it. Everybody uses it. It's like the euro. It's like they replaced the European currencies with the euro. So what? Now you use the euro, but it's still the same thing. You still take the money, you use the money, you get paid in the money, you pay somebody else. If they change it to blockchain, you'll do the same thing. You'll get the money, you'll use the money, you'll pay somebody else. But if you're eliminating the banks, or if you can't eliminate the government, so you're going to have to figure out how to tax yourself and do whatever, or they're going to transfer the money to you, and you'll have to get a report that says we transferred this many Bitcoins to you, and this many Bitcoins went to Social Security, and this many went to this and that. What the hell difference is there at that point? So, yes, it's possible the blockchain could be a superior system that you want to use for transferring funds, and that it could be as good as money, but it shouldn't be better than money. It shouldn't be valued like it's 1,000 times better than money. What makes a Bitcoin worth $20,000? Nothing. It's a completely arbitrary number, and I wrote my article on that today. So read my article from this morning, and I talked about how come it's completely out of whack with the valuation. But we'll see. Maybe I'm wrong. I already have said it could go to $40,000, but at $40,000, I say it collapses. And it's already ridiculous, but just because it's ridiculous now doesn't mean it can't double from here. But after it gets to that point, when it becomes basically about as big as Apple computer, that's when it collapses. That's when people start realizing this can't keep going on. All right, I need to drink water. I mean, and I'm done for the day. But thanks. I'm sorry I started late, and we will pick it up again next week. All right, take care.